The Dogs of the Dow is an investment strategy which focuses on the Dow Jones Industrial Average, an index of 30 large, publicly owned companies. The strategy involves buying the 10 DJIA stocks with the highest dividend yield each year. These 10 stocks are known as the Dogs of the Dow. Investors would hold these stocks for 1 year, then repeat the process. This value investing strategy has become popular for its simplicity. The Dogs of the Dow strategy gained popularity in the 90s. Michael O'Higgins is credited with popularizing the strategy. He even wrote a book about it. However, the Dog strategy goes back even further, with similar ideas discussed in financial articles as early as the 50s. The strategy is based on several key assumptions. First, it assumes that blue-chip companies are resilient. These are large, well-established companies with a consistent history of paying dividends. They often have access to credit and strong management teams, factors which help them weather economic downturns. Second, the strategy assumes that high dividend yields can signal undervaluation. When a stock's price falls, its dividend yield rises, meaning investors get a higher return on their investment based on the dividend payment. Proponents of the Dog strategy believe that high-yielding Dow stocks are overlooked by the market. The strategy assumes that these stocks have strong fundamentals and the potential for price appreciation. Additionally, the strategy emphasizes the power of dividends and the dividend snowball, which can provide a steady stream of income for investors. Implementing the Dogs of the Dow strategy is relatively straightforward. First, investors would identify the 10 DJIA stocks with the highest dividend yields. In 2025, the Dogs of the Dow yield an average of 3.5%, and the stocks are Verizon, Chevron, Amgen, Johnson & Johnson, Merck, Coca-Cola, IBM, Cisco, McDonald's, and Procter & Gamble, with the highest yield among them being Verizon at 6.8%, and the lowest being P&G coming in at just 2.4%. The second step in the strategy is to divide capital equally among these 10 stocks. For example, if an investor had $10,000, they would allocate $1,000 to each stock. Finally, investors hold the stocks for 1 full year. At the end of the year, the process is repeated by identifying the new dogs and rebalancing their portfolio accordingly. The Dogs of the Dow may be an age-old strategy, but it does have a mixed track record. From 1992 to 2011, the strategy performed well. It matched the DJIA's average annual total return of 10.8%. It even outperformed the S&P 500's 9.6% return during the same period. However, more recent results have been less impressive. The strategy has underperformed in some years, especially during market bubbles. There are several variations of the Dogs of the Dow strategy. One popular variation is the Small Dogs of the Dow. This strategy focuses on the 5 lowest-priced stocks among the 10 dogs. The idea is that the cheaper stocks have more room to grow. From 1992 to 2011, the Small Dog strategy outperformed both the Dogs of the Dow as well as the broader market. It generated an average annual return of 12.6%. The Dogs of the Dow strategy has faced criticism over the years. Critics argue its equal weighting method is flawed. They argue that it ignores market cap and company fundamentals. Another criticism is its simplicity. It only considers the highest dividend yield. This can potentially lead to overconcentration in certain sectors. What are your thoughts on this strategy? Have you heard of it before? I personally will be avoiding this as I prefer to buy index or sector-based ETFs rather than single stocks. However, it could be a good benchmark to study for those who are looking to buy and hold single stocks with solid dividends. Thanks for watching. If you enjoyed the video, go ahead and smash that like button. Until next time, stay calm, stay informed, and stay invested.